Welcome back to the deep dive. Today, we are really strapping in for an intensive look at a company that's kind of fascinating. It's simultaneously one of the most dominant and yet maybe least known players in aerospace and defense. We're talking about HEICO Corporation.
Yeah, it really is the definition of a niche juggernaut, isn't it? I mean,
Mm.
this is a business that has just, well, successfully executed this decades-long compounding strategy. It's become this silent fixture, really, in nearly every commercial aircraft flying today.
Absolutely. And our sources for this deep dive, we've got a pretty hefty stack here. Investment analyses, some deep dive briefs, and their latest Q2 2025 earnings report. They all paint this picture of why HEICO gets compared so often to, like, a mini Berkshire.
It's that operating model, isn't it? Highly
Yeah.
disciplined acquisitions, very specific operational focus, and the returns are just, well, staggering. You mentioned the Mendelson family taking over in 1990.
Right. And since then, the total return has climbed past, what is it, 147, the 900%. It's almost hard to comprehend. Or an 86,000% return, depending on how you calculate it. It's on a path to maybe even becoming a 1,000 bagger.
Incredible numbers, and that return profile, it really is a roadmap. It shows how they've successfully leveraged this powerful, self-reinforcing economic moat. So our mission today really is to unpack how they did it.
Exactly. How did they secure that dominance? We need to focus specifically on their unique dual segment model, that regulatory fortress they've built, and also the risks. You can't ignore the risks that come with such high expectations and, frankly, a very aggressive M&A playbook.
Definitely need to cover the risks. So understanding the whole picture.
That's the plan. We're going to break it down into four key areas. First, the Mendelson era, the family's impact, the transformation, the culture they built. Second, we'll dig into the dual engine, the Flight Support Group, FSG, and the Electronic Technologies Group, ETG. How do they work?
And third, that moat. We have
Yeah.
to dissect that unmatched moat. The regulatory side, the trust, the pricing strategy. It's fascinating.
It really is. And finally, we'll hit the numbers. Financial performance, how they allocate capital, especially with all the M&A and the current challenges you need to be aware of, including that slightly complex dual-class share structure. Lots to cover. Okay, let's start at the beginning. The history of HEICO. It actually started way back in 1957 as Heineke Instruments, and the initial focus, medical lab products. Seems worlds away from aerospace.
Totally different field, yeah. But the shift, the pivot, it began in 1974. They acquired a company called Jet Avian. That was their first small step into aerospace components.
Just a toe in the water, initially.
Right. But the legacy medical business, it wasn't doing well. It struggled. And by the late 1980s, the whole company structure was basically ripe for a major change.
And that's the moment. That's where the Mendelson family enters the picture. The real inflection point was 1990. The family, Larry, Eric, and Victor Mendelson, they acquired a significant stake in this, well, struggling firm. It was a leveraged buyout.
A classic LBO scenario. And their first move was incredibly decisive, almost immediate. They sold off the non-core legacy lab equipment businesses, just cut them loose.
To focus entirely on aerospace, a bold move at the time.
Very bold. But you have to understand the context, the market opportunity they saw. It wasn't just generic aerospace part. They spotted a specific kind of critical regulatory gap or loophole that had opened up back in the 1980s.
Ah, this relates to that airline accident, right?
Exactly. After a serious commercial airline accident, the FAA mandated inspections, and these revealed some severe flaws in certain jet engine components specifically. The combustion chambers were failing prematurely.
Okay, so a safety issue drives regulatory action.
Right, and the critical problem was the big original equipment manufacturers, the OEMs, they simply couldn't produce the replacement parts fast enough to meet this sudden surge in demand. There was a huge bottleneck.
A market failure, essentially. The supply just wasn't there when needed.
Correct. So the FAA, they're under immense pressure. They need to ensure safety, keep planes flying if possible, minimize grounding. They had to look for alternatives. And they turned to the first independent supplier who was ready and able to reverse engineer these complex parts and provide a safe alternative. That pathway was the parts manufacturer approval, the PMA process.
And that supplier was?
Well, back then it was still Heineke Instruments, soon to become HEICO. They successfully reverse engineered that faulty combustor. And that initial moment, that high-stakes demonstration of capability and reliability under regulatory scrutiny, that became the bedrock of HEICO's entire reputation.
So their foundation was basically built on proving they could deliver equal, maybe even superior quality, precisely when the industry giants were stumbling on supply. That's quite an origin.
It really is.
Yeah.
And it set the stage for a pretty dramatic showdown. We absolutely have to talk about that critical lawsuit. United Technologies, which owned Pratt & Whitney at the time, slapped them with a massive $100 million lawsuit in the late 80s, early 90s.
Over patent infringement on those replacement combustion chambers.
That was the claim. But really, it felt like high-stakes corporate theater. It looked like an attempt by a giant to stifle this emerging competitor before it could even get properly started.
How did it play out?
Well, HEICO didn't just defend itself. They fought back hard, they won the case, were fully acquitted. But then they countersued something like 17 times.
Wow. Aggressive.
Very. And the settlement that eventually came out of all that litigation, it provided a huge financial catalyst. Larry Mendelson very shrewdly used that capital infusion to fuel their aggressive early acquisition strategy. It was a double win. It legally validated their reverse engineering PMA model, and it gave them the money to start compounding in earnest.
That's a powerful story, using a regulatory opening and then a major legal victory to literally fund the future growth. Okay, so they had the strategy, the capital. Let's look at the leadership structure that has guided this growth machine ever since. It's very much a family enterprise, isn't it?
Fundamentally, yes. And the clarity of their roles seems really integral to their speed and execution. Larry Mendelson's the father has been the chairman and CEO, setting the overall strategy and, crucially, the culture since 1990. Continuous leadership.
And the sons?
Eric Mendelson is co-president, heading up the Flight Support Group, the FSG. He's widely credited as the architect behind their dominance in the PMA parts market. And then Victor Mendelson is also co-president, but he runs the Electronic Technologies Group, ETG. He was responsible for launching and scaling up their high-tech defense and space units.
So, clear swim lanes, family continuity over 3 decades. That stability must have allowed them to embed a very specific corporate culture. Analysts often call it capitalism at its best. What does that actually mean in practice?
Yeah, that phrase gets used a lot. It seems to stem from 2 key pillars in how they operate. First, this idea of decentralization with discipline. The corporate headquarters is famously, intentionally kept extremely lean. Minimal bureaucracy.
Despite managing this huge portfolio, over 100 subsidiaries now.
That's right, a sprawling portfolio. And here's the metric that really tells the story. Roughly 80% of the companies they acquire continue to be led by their original founders or the existing management teams.
80%, that's staggering. It means they're not doing the typical acquisition thing where they buy a company, absorb it, and potentially crush the entrepreneurial spirit that made it valuable in the first place.
Exactly. They actively foster extreme autonomy. They buy the company, yes, but they're really buying the talent, the niche expertise, and that owner-operator mindset. And then they intentionally don't meddle excessively. They let those subsidiary leaders run their businesses.
How do they ensure alignment then with so much autonomy?
Through incentives, primarily. It's baked into the structure. First, over 400 HEICO employees reportedly own substantial company stock, often in their 401k plans, so team members have skin in the game. Second, and this is key for acquisitions, the management teams of the businesses they buy are typically required to keep a significant stake, maybe 10 to 20%, in their specific unit.
So their personal financial success is directly tied to the ongoing performance of their subsidiary and HEICO's overall stock performance. Smart alignment.
Very smart. It keeps everyone focused on long-term value creation. And this commitment to autonomy, it's paired with this really strong long-term focus that, interestingly, prioritizes customer trust, sometimes even over maximizing short-term profit. We saw that quote from Larry Mendelson.
Yeah, the one about leaving money on the table. We could charge more, but we don't. We leave money on the table in the short term to build something permanent. That really captures a DIRB philosophy.
It does. It means they intentionally hold back on their pricing power, even in situations where their moat might allow them to push prices higher. They understand that squeezing customers might yield a better quarter, but it risks eroding the long-term relationship and the trust they've built.
So that decision, prioritizing volume, loyalty, stable pricing it, actually becomes a powerful competitive weapon against the OEMs, who are often accused of price gouging on spare parts.
Precisely. It helps ensure industry-best turnaround times, good inventory availability, and it solidifies their reputation for being fair, for being reliable partners. Think about it from the perspective of a founder selling their niche business. They often want to sell to HEICO because they know their baby, their company culture, will likely be preserved and allowed to thrive, not just dismantled and absorbed into some huge, slow-moving corporate machine.
And does this translate internally? What about employee sentiment?
It seems to. The sources mentioned a pretty good Glassdoor rating, around 4.1 out of 5. Employees praised the technical challenges, the quality of work, and that autonomy we talked about. Though some did mention challenges with work-life balance, which isn't uncommon in demanding fields,
But turnover is low.
reportedly below the industry average of 12%. So it suggests that, on balance, the culture is working to retain key talent, which is critical in this industry.
Okay, let's shift gears and really get into the core of the business model. How exactly do they make money day to day? The strategy seems built on a playbook that's, well, incredibly simple in concept, but obviously requires ruthless execution.
That's a good way to put it. The core playbook is this. Find complex, relatively low volume, definitely non-commoditized components. Parts that are absolutely mission critical for aircraft or defense systems. Think things like specific engine blades, combustion liners, unique sensors, power supplies.
Things you definitely don't want failing mid-flight or mid-mission.
Absolutely not. So they identify these critical parts, then deploy their engineering teams to reverse engineer them, figure out exactly how they're made, what materials are used, the performance specs.
And that reverse engineering is the essential first step before they can even think about getting that crucial FAA certification, the PMA, right?
Exactly. The PMA is the goal. Once they achieve that certification, proving their part is identical in form, fit, and function, or even potentially superior to the original OEM part, then they can legally sell it into the aftermarket.
And here's the kicker. They sell it at that substantial discount, typically 30 to 50% less than the OEM price. That creates an immediate, almost undeniable value proposition for the airlines or defense contractor.
Adds a massive value prop. They're essentially exploiting a huge structural inefficiency in the aerospace market. OEMs often sell the initial aircraft or engine at a pretty low margin, sometimes even break even or a loss.
Expecting to make all the profit later on the spare parts, the aftermarket, often decades down the line when things start wearing out.
Precisely. It's the classic razor and blades model, but for multi-million-dollar machines. HEI, too, acts almost like a market regulator in that sense. They force more competitive pricing from the OEMs just by offering a reliable, safe, and significantly cheaper alternative.
Okay, let's break down the two main segments where they execute this playbook. Starting with the bigger one, the Flight Support Group, or FSG. This was, about 68% of their revenue in 2024?
Yeah, FSG is the powerhouse. It's the undisputed global leader in that PMA space we've been talking about. They're designing, manufacturing, and selling PMA parts, definitely. But FSG is broader than just part sales.
Right, they also have a significant maintenance, repair, and overhaul service component, MRO, and they distribute parts too, both their own PMAs and sometimes even OEM parts.
Correct. The scale here is just immense. Estimates suggest they hold around 50% of the entire global PMA market, and their product catalog is vast, over 20,000 unique FAA-approved components.
And the customer list reads like a who's who of aviation. 19 of the top 20 global airlines, plus major defense clients like the U.S. Department of Defense. What makes this market so sticky for HEICO, particularly with the airlines?
The stickiness really comes into play during the sweet spot of an aircraft's life cycle. We're talking about planes that are typically between 10 and 25 years old.
Why that age range specifically?
Well, by that point, the original OEM warranties have usually expired, and just naturally, component failure rates start to climb as the aircraft ages. This is when the often, let's say, punitive pricing of OEM replacement parts really starts to bite into an airline's operational budget.
So the 30–50% savings HEICO offers isn't just nice to have, it becomes almost mission critical for the airline's own profitability, especially in a typically low-margin industry like airlines.
Exactly. Saving millions on necessary parts goes straight to their bottom line. And HEICO's scale, particularly on the MRO side, adds another layer of advantage.
You mean the repair stations?
Yeah. They operate 21 component repair stations globally. That makes them the largest independent component repair network in the world. So when an airline has an aircraft on ground, an AOG situation because a specific part failed,
which is incredibly expensive for the airline, losing revenue every hour it sits there.
The single biggest operational cost, often. Having that integrated network where HEICO not only has the replacement part, but also the certified facility and technicians to potentially repair or install it quickly, that drastically cuts down grounding time. It makes them an essential partner, not just a parts supplier.
Okay, we absolutely have to talk about the Wencor acquisition in 2023. That seems like a landmark deal. They bought Wencor Group, who is the #2 player in the PMA market, for a hefty $2.1 billion. That must have sent some shockwaves through the OEMs.
No, it was a massive game-changing deal. Strategically, it did a few crucial things. First, like you said, Wencor was the clear #2. Buying them instantly doubled the sheer scale of HEICO's PMA business overnight. It added about $725 million in annual revenue right away.
Huge jump in size.
Huge. Second, it effectively removed their largest direct competitor from the field. This simplified the PMA landscape significantly, consolidating HEICO's leadership position. And third, maybe most importantly long-term, it consolidated even more institutional knowledge, engineering talent, and specific component approvals under one roof.
Making that barrier to entry for any future potential competitors even higher than it already was.
Precisely. This wasn't just about adding revenue. It was a major strategic move to solidify market power and deepen their moat in the PMA space.
Okay, fascinating. Let's pivot now to the second engine of the company, the Electronic Technologies Group, ETG. This brings in the remaining roughly 32% of revenue as of 2024. This segment feels different, though. The value proposition seems less about cost savings and more about extreme technical superiority.
That's a perfect way to frame it. ETG isn't primarily playing the PMA game. Instead, it manufactures highly specialized, custom-engineered electronic and electro-optical components. These are designed for incredibly high reliability environments where failure is simply not an option.
So we're talking about things like what kind of components specifically?
Think miniaturized laser rangefinders for fighter jets, highly specialized sensors designed to withstand the harshness of deep space missions, hardened power systems for military applications, unique RF modules for secure communications, really cutting-edge stuff.
Okay, so the customer base would reflect that need for absolute perfection. Sources mention NASA, SpaceX, major defense primes like Raytheon and Lockheed Martin, and even specialized medical device companies like Medtronic.
Exactly. The technical edge is everything in ETG. The segment holds, I believe the number was around 590 active patents. That intellectual property defends its premium pricing. These parts are often very low volume, maybe even custom built for a specific platform or mission, but they command very high margins.
Because the cost of failure is just astronomical. If a critical sensor fails on a Mars rover or a guidance system component in a missile goes bad, it's not just an inconvenience, it's a catastrophic mission failure, potentially billions lost.
Precisely. So customers are willing to pay a premium for that guaranteed reliability and performance under extreme conditions.
So looking at the overall picture, this dual segment structure seems to provide remarkable resilience, doesn't it? You've got the transactional sales, mostly the FSG parts business, making up about 75% of revenue.
Which can be somewhat cyclical, tied to flight hours and airline health.
Right. But then you have that stable recurring revenue stream, about 25%, coming from the MRO services and other long-term service contracts, primarily within FSG, but maybe some in ETZ too.
And that 25% recurring revenue provides a really vital ballast, a cushion. When the airline industry inevitably faces cyclical downturns and maybe fewer new parts are being purchased, those ongoing MRO and service contracts keep the cash flow much more predictable.
Which is crucial for funding their ongoing M&A strategy, right? It ensures they can remain disciplined and opportunistic buyers even when the broader market might be weak.
Exactly. It helps smooth out the cycles and keeps the compounding machine fueled.
All right, let's dedicate some serious time to unpacking this economic moat. Because, honestly, it feels like the defining characteristic of HEICO. It's what truly separates them from, well, almost any other component supplier out there. They're not just selling parts, they're selling regulatory approval and, critically, this perfect safety track record.
You've hit the nail on the head. The barrier to entry here is immense. You could almost call it a regulatory fortress. The PMA process itself, just getting that initial parts manufacturer approval, is an enormous hurdle right from the start.
It's not just filling out some forms, is it?
Oh, not at all. It's not just getting permission. It demands years, literally years, of dedicated engineering investment, painstaking development work, rigorous testing, and incredibly comprehensive documentation. You have to prove definitively to the FAA that your replacement part is identical in form, fit, and function to the original OEM part it's replacing. Or, in some cases, you might even need to prove it's superior in some way.
And the FAA has to sign off on every single step, verifying the testing methodologies, the manufacturing processes, the quality control.
Absolutely. They scrutinize everything.
Yeah.
That institutional knowledge, just knowing how to navigate that complex process efficiently combined with the sheer persistence required, that must be an enormous constraint for any potential new competitor thinking about entering this space.
Just the time and capital investment alone would be daunting.
Hugely daunting.
Yeah.
Most companies simply don't have the deep bench of specialized engineering talent, or frankly, the capital endurance required to potentially wait years just to get their first few part approvals, let alone build a whole portfolio. HEICO, on the other hand, through decades of practice and refinement, they reportedly secure over 500 new PMAs every single year.
500 a year. They're constantly expanding their catalog, constantly widening that moat, making it harder and harder for anyone else to even begin to catch up.
Exactly. But then there's the real strategic weapon, the thing that truly accelerates their time to market and arguably defines their competitive lead even more starkly. That's the Organizational Designation Authorization Status, the ODA.
ODA. Okay, explain that. It sounds important.
It's more than important. It's like the crown jewel of their operational structure. ODA status is a very rare privilege granted by the FAA. It's only given to organizations that have demonstrated an absolutely impeccable, proven track record of quality, safety, and process integrity over many years.
And what does it allow them to do?
Essentially, it allows HEICO to act as a trusted extension of the FAA's own quality control system for many aspects of the approval process. They have the authority to self-certify certain parts and processes internally without needing direct FAA oversight for every single step on those specific items.
Okay, so what's the practical impact of that self-certification ability? How much time does it actually save them in getting a new part approved and onto the market?
It makes a monumental difference in speed. Think about it. For a typical new PMA part, if an OEM or some other non-ODA supplier has to go through the traditional full FAA review cycle for every stage, it might take, say, 6 to 8 months, maybe even longer, just for the final regulatory sign-offs. Because HEICO holds ODA status and can self-certify many elements internally, they can often slash that final approval timeline down to maybe 3 or 4 months.
Wow, half the time or even less?
Easily. This means they get their parts approved and available to customers much, much faster. They can capture market share quicker, they can respond to sudden supply shortages or urgent airline needs, long before competitors can even get their full application package submitted to the FAA, let alone approved.
That speed advantage, derived from years of proven trust with the regulator, that seems almost insurmountable. It compounds over time, doesn't it?
It absolutely does. But, as you alluded to earlier, none of that speed, none of that regulatory privilege would matter one bit if their safety record wasn't essentially perfect.
This is the bedrock, right? The trust moat.
It's the absolute foundation. The sources consistently highlight this almost unbelievable statistic. Over the decades, HEICO has shipped more than 85 million parts. And across all those parts, there have been 0 reported safety bulletins, 0 airworthiness directives issued against their parts, and 0 reported in-flight shutdowns attributable to the failure of a HEICO component.
85 million parts. 0 failures leading to safety actions. That's incredible. You simply cannot buy that kind of safety record, and you certainly can't fake it at that scale.
Impossible. That flawless performance sustained over decades across tens of thousands of different complex components operating in incredibly demanding environments. That is the ultimate reason why airlines trust them and why the FAA trusts them enough to grant and maintain that ODA status. It makes the perceived risk of switching away from a proven HEICO part to some unknown alternative incredibly high for an airline.
So the trust is built on perfect execution. And then interestingly, they seem to leverage this trust, almost paradoxically, by maintaining that pricing discipline we talked about earlier.
Yes, it's a fascinating part of the strategy. They offer that baseline 30–50% discount compared to the OEM list price, which is obviously a powerful initial incentive for customers.
Right.
But their management philosophy on pricing goes deeper than just being the cheaper option.
Right, because theoretically, given their market position, especially after acquiring Wencor, they hold something close to a duopoly or even a monopoly on certain specific PMA parts. Why don't they just incrementally push those prices higher year after year, squeeze a bit more margin, maximize those short-term quarterly profits like many companies would?
Because, it seems, they learn the lesson from watching the OEMs they compete against. The Mendelsons appear to understand fundamentally that it was precisely that OEM practice, perceived price gouging on essential spare parts, that created the market opening for alternatives like HEICO in the first place.
So they don't want to repeat the behavior that created their own opportunity.
Exactly. By explicitly restraining their pricing power by committing, as Larry Mendelson stated, to only passing through their own legitimate internal cost increases,
Right.
and deliberately not trying to maximize short-term profits from loyal, long-term customers, they build immense goodwill and ensure deep customer loyalty. They are clearly optimizing for long-term volume growth and market share gains, not short-term profit extraction.
So in effect, their price restraint isn't just about being nice, it's a deliberate strategic choice. It reinforces the moat by keeping customers loyal, And, crucially, preventing future potential competitors from having an easy price target to undercut if they ever manage to get past the regulatory hurdles.
Precisely. It turns the switching costs, which are already high due to the safety record and qualification requirements, into a massive psychological and financial barrier. Once an airline has qualified a HEICO part, knows it's safe, knows the price is fair and stable, why on earth would they take the enormous risk of switching to some other, potentially unproven third-party supplier just to save a few extra percentage points, if that?
Especially when safety is paramount.
Right. Paramount. And then by integrating the MRO services alongside the parts business, they further lock the customer into their ecosystem. Becomes a one-stop shop for certain parts, repairs, and the associated engineering support, making it even stickier.
Okay, so this disciplined, moat-protected strategy focusing on niches, regulation, trust, and price restraint. It's clearly generated some truly exceptional financial returns over the long haul. We mentioned the stock return earlier, but looking at the core business growth, a compound annual growth rate, a CAGR, in net sales of around 16% ever since 1990. That's incredibly consistent growth.
It really is. They went from, about a $26 million in sales back when the Mendelsons took control to nearly $3.9 billion, $3.86 billion in fiscal 2024. That's phenomenal compounding over 3 decades.
And the recent results suggest the machine is still firing on all cylinders. The latest numbers we have from Q2 fiscal 2025, they reported a record quarter, didn't they?
Yes, across the board, it looked very strong. Record sales, record income.
Let's break down some of those headline figures from Q2. Consolidated net sales were up 15% compared to the same quarter last year. That's impressive top-line growth in itself.
Very solid. But what's often more telling about the underlying health of the business is the organic growth rate stripping out the impact of recent acquisitions. And that was also very strong, at 14%.
So the vast majority of that growth was coming from the existing businesses performing well, not just from buying revenue.
Exactly. That indicates strong demand and good execution. And the segment performance provides a bit more color. The Flight Support Group, FSG, saw sales jump 19%.
Driven primarily
by really impressive 16% organic growth, specifically in their aftermarket parts sales. That suggests a few positive trends are probably at play. Likely continued recovery in global flight hours post-pandemic, maybe increased utilization rates of those older aircraft that are in high-ASO sweet spot, and also probably excellent execution on integrating that big Wencor acquisition, getting synergies and cross-selling opportunities.
Makes sense. Now, the Electronic Technologies Group, ETG, its growth was slower in Q2, about 7% total sales growth with 4% organic growth. That sounds a bit more modest compared to FSG's tear.
It does on the surface, but you need context. ETG is the high-tech, defense-heavy side. Management specifically noted in the earnings call that their defense-related sales in that quarter were coming up against a very tough comparison from the prior year, where there had been a massive spike in orders related to certain programs.
So lapping a period of unusually high demand.
Exactly. So viewed in that light, achieving 4% organic growth actually shows continued underlying stability and demand in their highly specialized defense, space, and medical markets. And they sounded quite bullish about the second half of the year.
Expecting defense tailwinds to pick up?
Yes. They specifically mentioned anticipating significant acceleration driven by existing defense backlogs, funding clarity on key programs like the US DOGE, Distributed Operational Gearing Environment Initiative, and also increasing international defense spending, particularly from their established customer base across, I think, over 30 countries, often serviced through subsidiaries like Blue Aerospace.
Okay, growth looks solid, especially organically. What about profitability?
Also improving. The consolidated operating margin expanded nicely, hitting 22.6% in the quarter, and that flowed through to the bottom line. Net income rose a very strong 27% year over year, reaching $156.8 million. That suggests they're effectively managing costs, maybe realizing some synergies from Wencor, and generally leveraging their scale well.
And crucially for a company built on acquisitions, how did the cash flow look? That's the fuel for the M&A engine.
Cash flow looked extremely healthy. Cash flow from operating activities surged 45% compared to the prior year's Q2, reaching $204.7 million. That provides ample fuel for reinvestment, debt paydown, and future deals.
And speaking of debt, how's the balance sheet holding up after the big Wencor deal and continued smaller acquisitions?
They seem quite prudent there. The key metric analysts watch, the net debt to EBITDA ratio, actually improved. It came down to a very comfortable 1.86x at the end of Q2 2025, down from 2.06 just back at the end of fiscal 2024. So they're actively using that strong cash flow to deleverage, even while constantly scanning the horizon for their next acquisition target. Financial discipline seems intact.
Okay, let's talk more about that M&A engine itself. Over 100 acquisitions since 1990. This really is where that mini Berkshire comparison comes into sharp focus, isn't it? M&A isn't just something they do, it's absolutely fundamental to their growth model.
It's completely integral. You can see it in their capital allocation priorities. ABCO consistently reinvests a huge chunk of its operating cash flow. The analysis suggests somewhere between 70% and 73% historically, right back into making new acquisitions. They are systematically compounding shareholder capital by rolling up the fragmented landscape of niche aerospace and defense component manufacturers.
But doing over 100 deals, how do they possibly maintain discipline? That's where so many serial acquirers eventually stumble. They start overpaying, or they buy businesses they don't understand, or they destroy the culture of the acquired company trying to force integration.
It seems HEICO avoids those traps by sticking religiously to a very clear, simple filter for potential targets. They look for, 1, founder-led businesses, where that entrepreneurial spirit is still strong. 2, companies operating in highly specialized, defensible niche markets. 3, businesses that are already consistently cash generative. And 4, crucially, targets that can be acquired at what they consider reasonable valuation multiples.
So buy quality businesses run by motivated people in good niches, pay a fair price, and then leave them alone to keep doing what they do best.
Largely, yes. That autonomy piece is key. They provide resources, oversight, maybe some back-office synergies, but they avoid heavy-handed integration. The latest deal mentioned in the sources, Rosen Aviation LLC, acquired in April 2025, seems to fit this mold perfectly. Rosen specializes in aircraft cabin displays, in-flight entertainment systems, very niche, specialized, requires deep engineering know-how, likely founder involved, cash generative. Ticks all the boxes.
So the outlook seems clearly tied to continued success on two fronts: executing these disciplined acquisitions and benefiting from the underlying organic market tailwinds in both commercial aerospace recovery and defense spending.
That's the formula. Management seems quite confident, citing the accelerating contribution from recent large deals like Wencor, which is still adding significant growth as it gets fully integrated, coupled with that strong organic demand in FSG. And then for ETG, as we discussed, they anticipate those defense programs and international spending increases really starting to kick in more significantly in the coming quarters.
Okay, one last piece on the financials before we move to risks capital efficiency. The sources note their model is inherently capital light, which obviously helps free up cash for M&A. Can you elaborate on that?
Yeah, this is a subtle but really important point about their model. Unlike, say, an airline or a heavy manufacturer, HEICO's own capital expenditure, their CapEx, is incredibly low. It typically runs at only about 1.5% of their annual sales.
Wow, 1.5% is tiny for a company making physical components.
Extremely low. Much of the heavy capital investment was already made by the companies they acquire, or it's baked into the specialized tooling, which might be customer-funded in ETG. This low CapEx requirement means they convert a very high percentage of their operating cash flow directly into free cash flow, the cash left over after maintaining the business. And that free cash flow is what gives them the firepower for acquisitions and debt reduction.
Makes sense. But how does this translate into return on invested capital, ROIC? Because with all that M&A, the balance sheet must carry a lot of goodwill, which can sometimes distort standard ROIC calculations, right?
Exactly. This is a critical insight for anyone trying to assess the true quality and capital efficiency of HEICO's M&A strategy. When you look at their standard reported ROIC based purely on GAAP accounting, it might look, well, decent, but perhaps not spectacular, maybe in the low double digits.
Why the potential distortion?
It's because of goodwill. Remember, goodwill in accounting represents the premium a company pays over the fair market value of the identifiable tangible and intangible assets when it buys another company. Since HEICO is constantly buying these founder-led businesses, often paying a premium for the unique talent, the customer relationships, the niche market position, and the future growth potential, all things that are hard to put a specific value on a large chunk of the purchase price, often gets recorded as goodwill on HEICO's balance sheet.
Okay, so if they spend, say, $100 million buying a company, and maybe $50 million of that is allocated to goodwill, the standard ROIC calculation might treat that full $100 million as the invested capital denominator. But the return numerator only reflects the current earnings, potentially making the return look lower initially, especially right after a big deal.
Precisely. The standard calculation can make it seem like that goodwill portion of the investment isn't really working or generating immediate returns. But analysts who focus on long-term business quality often argue that this goodwill absolutely is active capital. It was strategically deployed to purchase future earnings power, market share, and compounding potential.
So how do they adjust for this to get a better picture?
They typically make adjustments.
Sure.
One common method is to add back the amortization of intangible assets, which GAAP requires but doesn't reflect cash flow, to the earnings numerator, and sometimes adjust the invested capital base to better reflect the ongoing economic reality of the acquisitions. When analysts perform these kinds of adjustments to calculate an adjusted ROIC for HEICO, the figure jumps significantly.
What level?
The sources we looked at suggest that calculated adjusted ROIC for HEICO is around 16.5%, and that figure comfortably surpasses the widely accepted benchmark of 15% that often signifies a high-quality compounding business. It provides strong evidence that, despite the complexity of accounting for goodwill, HEICO's M&A engine is indeed highly efficient at generating strong returns on the capital it deploys over time.
Okay, we spent a lot of time establishing HEICO's immense quality, its strong moat, its impressive track record, but no investment is risk-free. Every machine, no matter how well-oiled, has potential failure points. Let's turn our attention now to the risks and challenges, starting with the operational side.
Absolutely critical to consider the risks. And for a manufacturer like HEICO, supply chain vulnerabilities are always near the top of the list. They rely on some highly specialized raw materials, things like specific titanium alloys for engine parts, certain rare earth elements for advanced electronics, precision components sourced from maybe only a handful of suppliers worldwide.
And these often have long lead times, right?
Very long, historically. The sources mention lead times that can stretch anywhere from 6 to 18 months for some critical inputs. So, if global supply chains tighten up again, perhaps due to geopolitical issues, or logistics bottlenecks, or just surging demand, that could directly impact HEICO's ability to manufacture parts quickly.
Which would undermine their key value proposition of having industry-best turnaround times and inventory availability.
Exactly. It could force them to hold more inventory, tie up capital, or worse, lead to production delays that disappoint customers. And any significant increase in raw material costs, if they can't pass it all through due to their pricing discipline philosophy, could also directly erode their margins. It's a constant juggling act.
Then there's the elephant in the room, operationally speaking.
Yeah.
The failure risk.
It really is the ultimate existential threat, the Achilles heel for a company built on safety and reliability. That zero accident, zero airworthiness directive record we discussed. It's the absolute core of their moat, the foundation of trust with airlines and regulators.
So a single incident.
A single, catastrophic, high-profile failure of a critical HEICO part, especially if it led to an accident, could instantly shatter decades of meticulously built-up trust. It would likely trigger massive regulatory scrutiny, potentially jeopardize their coveted ODA status, and cause irreparable damage to their reputation. Maintaining that perfect safety record requires continuous, absolutely flawless execution across hundreds of subsidiaries and thousands of parts. The pressure is immense.
And related to execution, we also have to mention the people risk, right? Finding and keeping the right talent.
Definitely. Technical expertise is paramount at HEICO, especially for the complex reverse engineering in FSG and the cutting-edge design work in ETG. But the aerospace industry as a whole is facing a demographic challenge, an aging workforce, with many experienced engineers nearing retirement.
And attracting new talent into manufacturing and aerospace can be tough.
It can be. There's a well-documented skills gap emerging in many technical fields. So while HEI seems to have a strong internal culture that helps with retention, if they were to struggle significantly in attracting the next generation of top-tier engineers, or if those work-life balance issues, sometimes mentioned in employee reviews, were to lead to higher turnover in crucial technical roles, they could eventually lose some of that vital institutional knowledge.
Which could slow down their ability to develop those 500-plus new PMAs each year and keep the innovation engine running.
Potentially, yes. It's a long-term risk factor they surely have to manage actively.
Okay, let's pivot now to the market and financial risks. And there's one that feels particularly interesting and potentially disruptive looking forward. The threat of digital transformation impacting their MRO business.
Yes, this is arguably the most fascinating strategic challenge on the horizon, because the threat doesn't really come from another parts manufacturer trying to copy their PMA model. It comes from data, from digitalization, specifically the rise of predictive maintenance.
Explain how predictive maintenance could directly challenge HEICO's established MRO model. That's the 25% recurring revenue piece, right?
Exactly, that stable, recurring revenue stream. Historically, HEICO's MRO business thrives on traditional maintenance schedules. Components get overhauled after a certain number of flight hours or cycles, or they get repaired after a failure is detected, often through manual inspection. Predictive maintenance flips that script.
Oh, so.
It leverages the increasing number of IoT sensors being installed directly onto modern aircraft engines and components. These sensors continuously stream vast amounts of performance data in real time. Then, sophisticated AI and machine learning models analyze this data, looking for subtle patterns or anomalies that indicate a specific part is beginning to degrade well before it actually fails.
Ah, so instead of waiting for a scheduled overhaul based on averages or waiting for something to actually break, the airline gets an early warning sign that a specific component on a specific aircraft needs attention soon.
Precisely. It allows the airline to shift from reactive or scheduled maintenance to truly proactive, condition-based maintenance. They can perform smaller, targeted, often cheaper repairs or replacements before a minor issue cascades into a major component failure that requires a complex, expensive overhaul at one of HEICO's repair stations.
And if airlines can do more of this proactive work themselves, using their own data analytics, or perhaps partnering with specialized digital maintenance providers.
It could significantly reduce their reliance on HEI's traditional large-scale MRO services. It directly challenges that predictable 25% recurring revenue stream and potentially weakens the overall stickiness of the customer relationship that the integrated MRO network provides.
That feels like a fundamental strategic challenge. It forces HEICO, a company built on mastering physical components, to potentially pivot towards mastering data analytics and digital services. That's a huge shift.
It's a massive strategic question they'll need to navigate. How do they adapt their service offerings to thrive in a world of predictive maintenance? On the more traditional financial risk side, we also can't ignore interest rate risk.
Because of their reliance on M&A funding.
Yes. Their model relies heavily on using debt financing, at least in part, for many of their acquisitions. So a sustained period of significantly higher interest rates directly increases their borrowing costs. While we saw they're managing their debt prudently right now with the ratio coming down.
Right, 1.86x net to EBITDA is healthy.
Very healthy. But if rates were to stay elevated for a very long time or spike significantly higher, it could eventually start to strain their financial flexibility. It might make future acquisitions more expensive, potentially forcing them to slow down their deal pace, which in turn could slow their overall compounding growth rate. It's a factor to watch.
And lastly, international exposure. They generate a significant chunk of sales outside the U.S.
About 38% of their 2024 sales came from foreign markets. That obviously exposes them to currency fluctuations. A stronger dollar can hurt reported revenue and profits from overseas. But perhaps more significantly, especially for the ETG segment with its defense focus, it exposes them to geopolitical risks.
Like export controls or shifting alliances.
Exactly. Any significant escalation in trade tensions, new export controls on sensitive technologies, or major shifts in defense spending priorities by key international customers could certainly complicate their distribution, regulatory compliance, and future sales opportunities in those markets. While rising global defense spending is currently seen as a tailwind, that international dependence always carries inherent risks that need monitoring.
Okay, before we wrap up with the final takeaway, we absolutely need to provide that critical learner insight on HEICO's somewhat unusual dual-class share structure. This often trips up new investors looking at the stock.
Yes. This is vital to understand, especially if you're comparing the prices of the two tickers. HEICO operates with two classes of common stock. There's HEI, which carries full voting rights, 1 vote per share, and then there's HEIA, which has limited voting rights, only 1/10 of a vote per share.
And if you look at the stock charts, there's almost always a persistent price gap between these two. As of mid-2025, the sources indicated that HEI, the full voting shares, were trading at roughly a 21.6% premium compared to the HEIA shares. That's a significant difference.
It is, and that premium essentially reflects the value the market places on those extra voting rights, on having more corporate control.
But here's the crucial point for the average individual investor.
This is the key takeaway. The Mendelson family, through their significant ownership concentration, primarily in the high-vote HEI class shares, maintains effective voting control over the company, regardless of how public shareholders vote their HEI or HEIA shares. For all practical purposes, public shareholders cannot currently change the control structure.
So the extra voting rights attached to the public HEI shares don't actually give those public holders any real additional influence over the company's direction compared to the HEI shares.
Not in practice, no.
Right.
And critically, the economic rights the entitlement to dividends, the proportional ownership of the company's assets, the claim on future cash flows. These are absolutely identical for both HEI and HEI shares on a per-share basis.
So for the long-term investor who's focused purely on participating in HEICO's economic success, its business performance, and its compounding potential, rather than trying to exert corporate control.
The HEIA shares, the limited voting shares, have historically offered significantly better value. You get the exact same economic ownership slice of this incredible compounding business, but you acquire it at a substantial, persistent discount, that 20% plus gap compared to the HEI shares. For most investors focused on returns, HEIA has been the more logical choice.
That's a really important practical point. Now, even considering that discount for HEIA, we still need to provide some context on the overall valuation. HEIO is clearly a premium, high-quality company, but does the current market price reflect that quality, perhaps even overly so?
That's the multi-billion-dollar question, always. The investment analysts cited in our sources suggest that, yes, the stock trades at a significant premium. Their models indicated that the current stock price, even for HEIA, seems to imply a market expectation or requirement for HEIA to generate something like 25% annualized growth in free cash flow over the next decade just to justify today's price.
25% annual growth for 10 years straight. That sounds like an extremely high bar, even for a company as good as HER, especially when we noted their own, perhaps more realistic, base case growth expectations might be closer to the 15–17% range, blending organic and M&A.
It's a very tall order. Sustaining 25% FCF growth for a decade is incredibly difficult for any company, especially as they get larger. So what does this tell us about the market's current view? It suggests a huge amount of optimism is already baked into the stock price.
Price for perfection, essentially.
Pretty close to it. Another way to look at it is through the current free cash flow yield. Based on recent numbers, HEICO's forward FCF yield was sitting around 2.1%. Now, if you compare that very low current cash return to a relatively low-risk alternative benchmark, like maybe the U.S. 10-year Treasury bond yield, which might be yielding closer to 4.5%.
The market is clearly demanding a very high future growth rate from HEICO that implied 25% to compensate investors for accepting such a low current cash flow return relative to safer alternatives. The market isn't pricing the current financials so much as it's pricing the perceived durability and longevity of that incredible economic moat. #outro. Well, this has been a truly fascinating deep dive. We've really peeled back the layers on HEICO Corporation. What emerges is this picture of, well, exceptional founder-led management, this unique decentralized operating model that somehow fosters both autonomy and discipline, a really powerful regulatory moat secured by that rare ODA status and, crucially, that impeccable safety record.
And underpinning it all, that clever cost advantage delivered consistently through the PMA playbook and FSG, complemented by the high-tech specialization in ETG. They fundamentally mastered the physical world of complex aerospace and defense components. They built their empire by offering unmatched reliability and significant cost savings, effectively forcing the giant OEMs to compete more fairly on price.
A remarkable story of execution. But as we spent some time discussing towards the end, perhaps the biggest strategic challenge facing them now isn't necessarily fighting those traditional physical giants of the OEM world anymore.
Right. It seems the most potent, maybe most disruptive challenge on the horizon is actually the intangible threat of data, specifically the rise of digital predictive maintenance, which, as we explored, has the potential to fundamentally undermine that stable, sticky, recurring MRO service revenue that provides so much ballast to their business model.
Which leads us to a really interesting final thought, a provocation perhaps for you, our listeners, to consider as you digest all this.
It really boils down to this question. Can a company like HEICO, a decentralized acquisition-fueled machine that built its empire by meticulously reverse engineering physical metal parts, can it successfully pivot? Can it innovate fast enough in the digital realm, developing or acquiring the necessary data analytics and service capabilities to protect, maybe even grow, its crucial service revenue streams in the face of predictive maintenance?
Or could it be that their greatest strength, that very decentralization, actually proves to be the key? Will allowing their 100-plus autonomous subsidiaries the freedom to experiment, to acquire nimble digital players, or develop their own niche data solutions enable HEICO to adapt more rapidly and organically to this digital threat than a more centralized corporate structure ever could?
That fundamental tension between their historical mastery of the physical world and the growing necessity to master the digital world that feels like it will likely define the next crucial phase of growth and evolution for this incredibly impressive yet complex aerospace powerhouse.
Something to definitely keep an eye on. Thanks for joining us for this episode of The Deep Dive.